From Markets with May. Happy Cinco de Mayo. Hope everyone had some really exciting plans for this evening. We are going to be talking about AMC, and we'll keep it kind of on the shorter side, but I'll take as much Q&A as I can before Cinco de Mayo celebrations. But we have earnings today, and I want to go through them. And I'm going to go through them with the stuff that I think possibly are already kind of coming out strangely. And I think it has to do, oh my goodness, a piece of salad in a weird way. I think it has to do with just, people are starting to get better and better at reading financial statements, but they're still either missing context or they're like here and they just need to keep going deeper. And yeah, so let's go through. This was a good quarter. If that's confusing to anyone, this was a really good quarter. And the way to think about it once again is that this is a turnaround story. So what we're looking for, four things that I've kind of laid out. Number one, is the business recovering? Number two, is the business improving profitability? Number three, are we making progress on the capital structure? Meaning, are we paying down that debt? And are we improving the ability of the company to have financing? Okay, that's number three. Number four is, are there new forms of revenue, new forms of business lines, new ways for this company to emerge from its old business model into its new business model? And I remind everyone that this thing has been in turnaround for a while, was making progress, and then COVID hit and it like destroyed what was the progress that was made and required a totally different capital structure. So these things don't change, even if the turnaround's taking a long time. There aren't that many turnarounds that survived COVID, okay? So again, four things: business recovery, is it becoming more profitable? What's going on with the cap structure? And are there new forms of revenue? That's the four things we're going to go through. Okay. And you guys know, full disclosure, I still own my APE shares because honestly, my thesis hasn't played all the way out yet. So even though like the first video I did was when it was at 70 cents, maybe even sub 70 cents. Anyways, you know what happened as far as that goes. And most of you guys are APE shareholders. APE is 150 and change. AMC is doing fantastically because this was a good quarter. And, that's kind of where we're going to start at. On the disclosures, past performance, not indicative of future returns. And again, as I've mentioned, this is a turnaround story. So if you don't even have a concept of being able to understand turnarounds, this may or may not be your deal. I get it. But turnarounds financials are going to look ugly. You have to be able to look at the strategy and then put the strategy into the financials, or else you will get this story completely wrong and you will misread the financials, which is what I'm already seeing people do, period. Okay. All right. I love that you guys are putting stuff in the comments. I will try to address them, but I try to address them at the end, but keep them there because I do try to scroll all the way up. All right. So my little notes for myself. Income statement. So this was the top line numbers that came out. So you have revenue up 21%. We're still at an L for the quarter, but that's much better than the previous year over year. And then EPS is still a negative. There's still dilution, obviously there's still, the diluted EPS is still negative, but a notable improvement. But what we care about is actually those metrics that give you a better sense for cash flow and what is the revenue going to be like in the future. And what is the revenue and income going to be like in the future? Because we know we have to pay down the debt. Okay, that's what it is. And then before we can really get off into the races. So adjusted EBITDA finally coming in positive. Okay, and then free cash flow improvements, but still slightly negative. That is what it is, but I'm going to go through that because there's a lot of reasons for you to be okay with that for this quarter, which promises to potentially be the last. I won't say that it's the last because you really don't know how things transpire, especially since there will be a little bit of cash usage for some of the acquisitions, because part of the story is to close down non-profitable theaters and strategically and opportunistically take advantage of what's going on in the theater business and acquire properties that are strongly cash flowing and make sense for the future of AMC. Okay, so that we have to watch very carefully. Okay. I think I probably have one slide that I'm missing, but let's just go through it. AMC revenue up 20%. Okay, that's pretty good. I want to continue to see more there, but definitely given that last year was such a weird year in films and we know we're moving into improvements all throughout this year, this is great. I wanted to put for context for you what it was relative to 2019 because the bears on this are all about the fact that nobody's going to the movies anymore. Streaming's going to take over everything. La da 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 da. Okay, maybe, but it actually doesn't, it looks like it's almost fully recovered to 2019. And I see this in a lot of different industries that got slammed by COVID. So, there is that element of it. So 2019 revenues were 5.4 billion. So that would be, last year relative to this year, down 38%. So I kind of want to start in the further quarters out to see the growth even more than that so that we can really show clearly that the business has recovered to 2019 and is growing forward. Okay. What was interesting to me is the components that you can see very clearly. I went ahead and did the math for you. There's an admissions line item, and then there's a film exhibition cost line item. That's 46% gross margin versus 42% gross margin. Okay. So we are, it's really hard to call that per se gross margin because that does actually have a very specific financial term, but you can think of it somewhat in that way. And the margins on just buy the ticket, go in, they purchase nothing else, did improve 46% versus 42%. Same thing with people buying concessions. And we know that that was a little bit of an issue only because raw material costs, labor, all that stuff is getting more expensive. And they talked a little bit to that and have over the quarters, but that is also improving 18% versus 16%. Okay. And then you get a couple of different things. I put the dashed line there because that dashed line is the stuff that is not reoccurring. Okay. So when we think about profitability, yeah, we got to look at this number, but we also have to think about what is gone after this point, right? And what is gone is merger and acquisition costs, even though we'll still have them, but they'll be in a different context, okay? Because there are going to be further thoughtful purchases, let's call it, and some of them, the merger math on that will go all over the map. Also, depreciation amortization, that's just like with your house. That all that does is lower your tax bill. It's non-cash. Okay. So that we have to remove that. And then the other number that has to be removed is, so two forms of DNA. Okay. So then when you do that, you get 896 million as the operating cost and expense during this quarter, which absolutely is an improvement over last quarter. Hence, you end up with better, that's why you end up with less of a loss. Let's just make it simple, okay? So this was an improved margin quarter. All right, next part. This was the revenue mix. Some of you guys probably already saw this very clearly. US is up more than international. Prices were down, but they were compensated by average food and beverage revenues per person. So overall, even though they're doing the whole mixed ticket pricing in an effort to try to manage inflation for certain folks that can't buy the more expensive tickets, you still end up, because those that can afford greater tickets are happy to pay for the difference in the price of having the seat that they want. And also they're just buying more concessions. Okay. So the revenue mix looked good. So remember, as I mentioned before, the questions we're asking is the business recovering? Yes. We still need to see a little bit more in the quarters to come. Number two, is it more profitable than it was before? And the answer to that is also yes. Okay. So these are two really good signs on the road to improvement for AMC. Still going to be a rough ride, guys, but let's keep going. This is the geography mix. I mean, this is good. You can see, US increasing, international increasing. So, that's great. We still have a little bit of EBITDA negative going on in international markets. That's because the recovery isn't done yet there. We'll need to monitor that as shareholders. That is what it is. Okay. So I don't have a lot to say on that particular piece. Balance sheet. Let me talk balance sheet, because boy, did I see some stuff on balance sheet that was just completely out of context. Let me say it's not wrong. And I kind of get it, because For a lot of people, they don't usually look at the balance sheet that much. And when they do, they're really just pulling out pieces here and there. You guys have to remember something fairly important, which is this is the quarter where we really actually see the impact of that debt pay down via Antara. So I'm going to show this to you in a couple different ways. Actually, let's go back to the income statement on the line item that I think people misunderstood. It's right here. It's corporate borrowings. So operating loss, so earnings before interest tax, EBIT, right? That's what operating income is. And then DNA, so interest expense goes below the line, below operating. And it looks here, so 82 versus 90. And a bunch of people were like, oh, interest expense increased. That's a problem. And then they went to the balance sheet and they read it. But that interest expense is the payoff of debt. That's the same as like when you have to, and I'll show you exactly what's implied. But if you pay some of your loans off early, sometimes there's a penalty that was put in there, but longer term, you pay down the debt. So let's actually really look at this correctly. Okay. So, all right, here's the balance sheet. Cash, we know that cash is down a bit, restricted cash. We know that there's, that has certain elements to it as well. I'm not going to deny that there was less cash. Okay. However, let's look at corporate borrowings, and you can see that this decline in cash is more than compensated for by the decrease in corporate borrowings. And also, you have to think about it in terms of like, well, is that enough? And what does that mean and imply? We'll go through that in a second. Also, I want to tell you that some people oftentimes leave out operating leases. They should not, because operating leases is a particular type of debt that more or less, whenever I'm looking at companies like this, I can't ignore that. So I'm not even giving them credit by separating out the operating leases, but you can see that that went down. So operating leases in this context is primarily the real estate. And so as they sell off the unprofitable theaters or close down theaters or roll down theaters, that's what that is. And that's why that's declining. Corporate borrowings, realize that they did this change in corporate borrowings, this decrease during one of the tightest markets as relates to the extension of credit to high yield companies. AMC is not AAA rated. We're not confused. No shareholder is confused that they, are a high yield in the high yield space, meaning that they are not going to have like a 2% rate or something ridiculous, right? So for the most part, most people could not term out their debt further in the last few quarters, but we know what Mr. Aaron did in December, right before Christmas, as a Christmas gift. Now let's actually talk about that Christmas gift. I did a video on this, and some people just pretended like I was lying. And I have no idea why you would think I was lying, since all the documentation is right there. But nonetheless, let's go through it for him anyways, okay? This right here, hold on. This right here. This is the aggregate principal. So the total debt repurchases was 103.5. The reacquisition cost was 56.5. So that's what it cost him to kind of pay off the debt, right? Because of the nature of this type of debt versus if you're just getting your mortgage. And then on the gain on extinguishment of debt, that's because he bought it at 35 cents on the dollar. That's what the 65 cents is right there. So that if you think about it as a dollar, 56 cents, 65 cents. So he's out of it with interest payments at a slight cost to us, but no reoccurring interest expense on this. That's why we, the shareholders, were like thumbs up at Christmas time. That's what that extra cost is that everybody's so on about. And quite frankly, I got trolled the other day. You guys know how passionate I am on Twitter. If you troll me, it really agitates me if you get me in the wrong way. And it was like, oh, but his debt is trading at 35 cents on the dollar. Well, if we can actually get to cash flow positive, then this is the type of stuff that he can do. Now let's go through the debt even more than this, because this is not adequate to fully cover it. Remember, the point is there progress on the balance sheet? The funding of the company, has it improved? The answer to that is yes, versus 2019. This is what you'd look at. The bottom part is from the Q4 2019, because the balance sheet's always a snapshot in time of what's going on. The top is what we got in the release. And you can see current liabilities are lower, okay? And also operating lease liabilities are lower, debt is lower. So his cost of everything has been lowered, despite the fact that we are really this year looking to be very close to the revenues of 2019, okay? To me, this is progress. If someone else wants to pretend like it's not, okay, But I don't really know what to say to you other than let's see if that's the case. But you have to at least acknowledge that this happened when you start throwing and trolling my account with how much they are not doing on the debt side of the balance sheet. Okay, so that's what I have to say to that. Shareholder litigation expense. I do want to just show. Wait, let's see. Yeah, shareholder litigation expense. I want to just show this because this is why so many of us are crazy agitated by this. There is actually a charge to us of 116 million in litigation expense. Now, I'm hoping that we can countersue on this. I don't actually know how that works. Somebody with a legal background, post it in my comments. I want to know. But this is the irritation that we all have because this is not what we need. That's why so many of us scream at the top of our lungs this litigation could only possibly come from short sellers because remember, we're still trying to move into cash flow positive. So given that he actually nailed the things that he said he was going to do, which is what you'd expect on a turnaround, i.e. improve the business model, increase profitability, modify and improve the capital structure. This is freaking annoying. Okay. All right. Let's see. What is there? Oh, I want to show this as well. Sorry, this as well, because, and then do a little discussion on the debt. Because you guys have caught me in a couple of videos gleefully suggesting why actually the capital structure of AMC isn't so bad relative to the new meme stocks that we're all watching, which is the banks. And it has to do with this, okay? He has termed out his debt structure for the shareholders. In every single, and I call it debt by vintage. Some people call it a vintage analysis, but usually it applies more to a different context. So this is May's special word by look. Okay, I'm not gonna. There's probably other people that call this table something else, but I call it debt remaining by vintage, like a vintage of wine. Okay, for this year, 15 million is the principal due. And then for next year, 24, and you can see most of the debt is due out in 2026. And so we watched the banking crisis with at least a feeling of knowledge that if we can get through some of these cash flow issues this year, 15 million, then we'll be fine for the 24 million due next year and the 118 in 2025. And then let's see what happens with 2026 if we can further term it out and what goes on with rates. So that's how you read this portion, okay? And so this part is going to be something that we're just going to have to continue to see improvements on. This is, again, the debt. Sorry, that's a debt extinguishment. One other place I just want to show you. Okay, this also in the K, you can review it. You can see which pieces of debt that were paid down. And we look at the senior secured credit facility due in 2026, but that rate is fairly low, all things considered. The ones that he paid down the most on is this 1012 cash PIK toggle lien sub 2026. What is a PIK toggle? A PIK toggle allows you to defer the interest payments. So it is the right kind of debt to have during the middle of COVID so that you can like have some flexibility on your interest payments. And that you will see an interest liability that matches that in the cash flow statement, and also correspondingly it'll show up in a particular place on the balance sheet. So I'm not going to show that because I didn't prep it, sorry guys, but for those that maybe are going to go behind me and also do an earnings recap, maybe that'll be helpful in case they weren't looking specifically at this piece of it. But but this still is a 10 to 12% interest rate in 2026. We paid some of it down. Okay, very cool. And then you can kind of see the other pieces. Oh yeah, I'm sorry. You can see it right here. I don't know why I felt like I didn't prepare it, but deferred financing costs. That's the debt. So we paid some of it down, and then during COVID, probably we deferred the payments, and that's what happened. I'm saying the shareholders or Mr. Aaron on behalf of the shareholders. That's what I mean by we, in case some of you guys are listening and wondering why I keep saying it that way. So this is great in my opinion, although there's still a lot of concern that we know we have if you're a shareholder, which is we got to keep working down this debt. Okay. But definitive progress, especially in the middle of a period where you've got a credit issue. Okay. Anything else that I prepped for this? Let me stop sharing and just double check some of my remaining slides. Okay. This one I wanted to show you. It was one little baby note that is in the filing versus the release. So there's an earnings release, and then there's the proper Q that's filed. And there was this little note. I'm pretty sure this was in the Q, but I'm not 100% sure. Ooh, my light almost fell on me. So, but it said that the company received a 13 million buyout incentive from a landlord, which provided the landlord the right to terminate the lease on one theater. The incentive was treated as a reduction to rent expense in the company's condensed statement of operations. And this don't worry about anything other, or the way that I really interpreted this. He talked to this a bit on the call, but it does imply that there are some of the landlords that just want out of the darn property, given that retail's been so weird. And it'll be interesting to find out more about this. Possibly some of the people that I admire on AMC that have been just covering it for longer may know a little bit more here. But to the extent that that dynamic is happening, if it benefits the AMC shareholders, that would be really cool to know a little bit more. But it wouldn't be something that we'd see right away. So that one I just thought was an interesting little note that I might be interested to find out more about. Okay, other notes, and then we'll kind of end this. Is this are we out of all the risk? No, we are not out of all the risk. Okay. That's the nature of a turnaround. You're going to have quarters that are great, and knock on wood, they continue. We do, however, have this incredible slate of movies that's coming out. And it does look like, great question, Tristan. It does look like it definitely looks like we have the possibility of 2024 being profitable, but we have to acknowledge, even though he made light of it, there is a writer's strike. Okay. And then it's just, as a shareholder, do you want to like discount him for some reason on the writer's strike? Do you feel like that's already baked in? Okay. So just realize that. The other thing is valuation, which I'm not going to try to do. I think there's other people that do a fabulous job, but I just wanted to get a quick reaction out. If we get back to 2019, then the sales of 2019 were about 5 billion. So you kind of got to make a call on how you feel about price to sales, which is what we'll trade at until this company becomes profitable. So I just want to throw that note out there for people. They're talking about it. However, the last little thing that I mentioned of the 4 things that we were looking for is, are there new forms of revenue? Are we transforming the company for the future to be a more profitable entity with a different set of revenue streams to supplement the fact that we are downsizing some of the theaters? And the answer to that is yes. Okay. So we do have, the answer to that is yes. There was one little note, and I really wish that they would have had a little time to talk about how profitable the popcorn stuff was a bit more on this call, because we know that that is actually selling out like crazy. We, the shareholders of, and folks that love AMC as a stock or otherwise, have been watching like crazy the fact that it isn't easy to get popcorn at Walmart right this minute, which tells you the sales have been good. But we haven't seen that broken out yet as a portion of revenue in the income statement. It's probably because it's still small. They're still ramping that effort up. He did, however, talk about the fact that they are thinking to do in the near future, no date was given, AMC branded candy. We'll have to see how that goes. Obviously, that's going to improve that section of the income statement where it says, cost of goods sold, the cost of the food and beverage portion. So that should be also really wonderful, either for that, or to the extent that he sells it outside of the theater, then we start to really get more on this concept of licensing revenue coming from stuff outside of the theater, which is something that I've been kind of excited about since the popcorn started. Additionally, it's interesting because even though their agreement with the Saudis does look to me like a franchising model, and I had wondered if he wasn't going to do that more in Europe, just because it tends to make all of it easier from an accounting perspective on how you'd hedge the currency, et cetera, et cetera, et cetera. That wasn't really a discussion, and those are very much so my words versus his words on how he's thinking about Europe. I don't know why, but the questions, there were so few questions. There was a lot to get through on the call. I wouldn't mind having, more time to answer those questions. So if anybody actually has a bit more access to Mr. Aaron, those would be great. If for some reason I get so lucky that Mr. Aaron actually ever watches my stuff, please do put it in the comments. I won't do anything. All right. So let's see what else we've got here. Let's see what else we've got. Let me go to the very top. Shout out to Novocaine, Dave. Thanks for showing up. As per usual, Juicy got you crazy. And I peed in Kenny's pool. You're so creative with these YouTube names. Thank you guys for coming and supporting us per usual. Do I think they'll make a recovery? It looks like, Corey, it looks like they're right in the middle of it. So, there's different types of investors. There's some that go in much earlier on the turnaround, and are, there's some that like wait a bit, what have you. I get that this one is not going to look, on historical stuff, it's going to look horrible because it is absolutely a turnaround. And so it's going to be for those that do future projections, a timing, and then what is the valuation. But like I said, there's notable progress over, like, since the post-COVID period. You've seen quarter after quarter of this is what we're going to do, and then he executes on it. So it's still kind of in that gray area with very notable progress. Let me say it that way. Okay. Okay, now you're just being a little silly. Okay, I know I put out that thing, but I was talking to Berkshire Hathaway analysts to take a look, only because it has these elements that are a little bit tougher on the financing side, and also how we would take distressed assets and make them more profitable versus just collapsing the company like a corporate raider. So that's why I mentioned it that way. But if it can turn profitable and it's just a certain type of business, it wouldn't be crazy to see it as a Berkshire business, but I know a lot of people will disagree with me on that, and I'm not going to go all the way there, even though I still think that that's the right skill set to evaluate this company. Buckeye Ace, shout out. James Harris, thanks so much for stopping by. FastX, that's awesome. I love that the shareholders, are into supporting the company. Me too. As you know, Tristan, I want to see it, but I think it just needs one more quarter before everything gets booked and we can really understand what the operating margins are on that and its contribution for the future. And then, okay, there's a lot of anger. Guys, be nice to each other. AA is the daddy. All right, guys. And then with that, that's all I've got for today. I apologize that I'm not doing quite as many AMC videos. It turns out the newest meme stocks, which are the banks, the regional banks, are getting just as much fear, just as much FUD, but in some cases it's FUD in the wrong direction. You know what I mean? Like it should actually be this, but instead this is being said, which is out of context, slightly wrong, or a little bit misleading, because I do think that there are some discussions that should be had, but because everybody's just like, oh, every single one of these banks is a bunch of crooks, therefore all of them deserve to go to zero, realizing that just means that you're going to consolidate into JP Morgan and a couple of others. That's not good. So I really do want to try to put out videos on the banks to give the individual investor a fighting chance of walking through the financials, because I do think bank financials are very difficult if you've got no one to help you read through them. 90% of it is just translating the jargon into reading financial statements that look more common to you. Something that looks like interest is actually revenue in a bank, for example. So we're going to do some of that, and so there'll be slightly less AMC going on, but I definitely wanted to cover this. We still have the shareholder lawsuit to clear, and good luck to everybody. Happy Cinco de Mayo, you guys. Make sure to enjoy the weekend.